Ladies and gentlemen, good day and welcome to the Q1 FY27 earnings conference call of Hexagon Nutrition Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. Nikhil Kelkar, Joint Managing Director. Thank you, and over to you, sir.
Good evening, everyone. Am I audible to all? I hope I'm audible to all of you. A very, very warm welcome to all our shareholders, analysts, institutional investors, member of the investment community, and everyone joining us today for Hexagon Nutrition Limited's Q1 FY27 earnings conference call. This quarter marks an important milestone for us as it's our first quarterly results announcement following our successful listing on the BSE and the NSE in June 2026. On behalf of the entire management team, I would like to thank our shareholders, customers, employees, partners, and all our stakeholders for their continued confidence and support. We are pleased to have started FY27 on a very strong note with a healthy year-on-year growth in both revenue and profitability. For the quarter one of FY27, our consolidated revenue from operations stood at 104.3 crores, registering a growth of 43.2% comparing with 72.9 crores in Q1 of FY26. Our EBITDA stood at rupees 11.8 crores, representing a year-on-year growth of 17.3%, while profit after tax stood at 8.1 crore, registering a growth of 25.1% over the corresponding quarter of the previous year. We believe this performance reflects the continued demand for our nutrition solutions and the progress we are making across our domestic and international markets. Let me briefly touch upon the broader opportunity that we see for the business. Nutrition is increasingly becoming an integral part of healthcare and wellness. Rising awareness around preventive healthcare, balanced nutrition, immunity, active lifestyles, and specialized nutrition requirements is creating a structural opportunity for this industry. At Hexagon Nutrition, our diversified portfolio enables us to participate across multiple segments of this opportunity. Our business spans micronutrient premixes, clinical nutrition, therapeutic nutrition, food fortification, and consumer nutrition. This diversification gives us the ability to serve customers across different applications and markets. Our focus continues to remain on building a diversified and scalable nutrition platform. Research and development remains at the core of our business. We continue to invest in developing innovative formulations and nutrition solutions that address evolving customer and healthcare requirements. At the same time, our manufacturing facilities provide us with a strong foundation to serve both domestic and international customers while maintaining our focus on quality, consistency, and operational efficiency. Our international presence is another pillar of our growth strategy. We currently serve customers across more than 70 countries, giving us a diversified geographical footprint and opportunities to further expand our presence in the international markets. We also continue to see significant potential in our clinical and functional nutrition businesses as consumer awareness around specialized nutrition continues to increase. As we move through FY27, our priorities remain focused on sustainable revenue growth, strengthening our international presence, innovation-led product development, operational efficiencies, and disciplined capital allocation. We believe the structural drivers supporting the nutrition industry remain strong, and our diversified portfolio, R&D capabilities, manufacturing infrastructure, and customer relationships position us well to participate in these opportunities. With that, I would like to now hand over the call to our Managing Director, Mr. Vikram Kelkar, who will take you through the operational performance and key business initiatives during the quarter. Thank you.
Thank you, Dr. Nikhil. Good evening, everyone. Let me take you through the operational performance and key developments across our businesses during the quarter. As Dr. Nikhil mentioned, we have started FY27 with strong revenue momentum. Our diversified business model remains central to our strategy, with our operations spanning micronutrient premixes, clinical and wellness nutrition, therapeutic nutrition, and food fortification. Let me begin with our micronutrient premix business. Premixes continue to be an important growth engine for Hexagon Nutrition. We work with the customers across food, pharmaceutical, and other industries, providing customized blends of vitamins, minerals, and other nutritional ingredients. We continue to see structural opportunities in this business, driven by increasing awareness around nutrition and fortification, as well as the growing adoption of fortified food products. The increasing focus on nutritional security and fortification, both in India and globally, provides a favorable environment for organized players with strong formulation, manufacturing, and quality capabilities. Coming to our clinical and wellness nutrition business, our Pentasure franchise continues to be an important part of our branded nutrition portfolio. We see significant headroom for growth in the clinical nutrition and wellness market, and we are continuing to strengthen our presence through our sales and distribution network. We are also focusing on increasing the penetration of our other branded products, especially Pediagold and Obesigo. As discussed during our previous earnings interaction, we are expanding our reach beyond Tier 1 markets and increasing our presence in Tier 2 and Tier 3 cities. This expansion is being supported by strengthening our sales force and distribution network. We are also working towards increasing our presence across e-commerce, e-pharmacy, and digital channels alongside our medical marketing initiatives. We believe these initiatives will help us to improve our brand awareness, increase consumer reach, and build our branded nutrition portfolio over the medium to long term. Our therapeutic nutrition and ESG business also remains strategically important. This includes ready-to-use therapeutic foods, ready-to-use supplementary foods, and micronutrient powders, which address important nutritional requirements across different geographies. The tender-based nature of a part of this business means that order flows can vary between quarters. However, we continue to see the opportunities in this segment and remain focused on building a healthy order pipeline. Coming to our international business, exports remain an important component of our overall business. Our geographical diversification provides resilience and allows us to participate in multiple markets. As we had stated in our previous earnings call, the geopolitical situation in the West Asian region has not materially impacted our business. Our exports are diversified geographically, and West Asia contributes less than 20% of our total exports. We therefore continue to see the opportunities to expand our international presence while maintaining a disciplined approach to market selection and customer relationships. On the manufacturing side, we continue to focus on improving capacity utilization and operating efficiencies. Our existing manufacturing infrastructure provides sufficient headroom to support future growth while allowing us to accommodate incremental orders and tender opportunities. We will continue to optimize our manufacturing operations, improve productivity, and maintain stringent quality standards as volume scale. Another important area of focus remains R&D and new product development. Nutrition is a constantly evolving field, and we believe our ability to develop differentiated formulations and respond to changing customer requirements will remain an important competitive advantage. We continue to evaluate opportunities across our existing product categories as well as the new areas that complement our capabilities. Overall, we remain encouraged by the opportunities across our businesses. Our focus for FY27 will remain on strengthening our core businesses, expanding our branded portfolio, increasing our international footprint, improving capacity utilization, and continuing to invest in innovation. We believe these initiatives will help us build a stronger and more diversified nutrition platform over the coming years. With that, I would like to hand over the call to our Chief Financial Officer, Mr. Soman Jana, who will take you through the financial performance for the Q1 FY27 in greater detail. Thank you very much.
Thank you, Mr. Vikram. Good evening, everyone. I would take you through the financial performance of Hexagon Nutrition for the first quarter of FY27. We have started the financial year with strong year-on-year growth across our key financial parameters. For Q1 FY27, our consolidated revenue from operations stood at 104.3 crore compared with rupees 72.9 crore in Q1 FY26, representing a year-on-year growth of 43.2%. This growth reflects the continued demand across our diversified portfolio and our ability to serve customers across domestic and international markets. Our gross profit for the quarter stood at 45.8 crore compared to rupees 34.1 crore in Q1 FY26, representing a growth of 34.1%. At the operating level, EBITDA stood at rupees 11.8 crore compared with rupees 10.1 crore in Q1 FY26, representing a year-on-year growth of 17.3%. Our EBITDA margin stood at 11.3% during the quarter compared with 13.8% in Q1 FY26. The movement in EBITDA margin needs to be viewed in the context of the business and the product mix during the quarter, along with the investments being made to support our next phase of the growth. We remain focused on improving operating leverage as the business scales and on maintaining an appropriate balance between the growth and the profitability. Profit before tax stood at rupees 10.6 crore during Q1 FY27, registering a year-on-year growth of 25.1%. Profit after tax stood at rupees 8.1 crore compared with rupees 6.5 crore in Q1 FY26, representing a growth of 25.1%. PAT margins stood at approximately 7.7% during the quarter. Overall, we are pleased that the strong revenue growth during the quarter has translated into healthy growth in absolute EBITDA and the PAT. From a cost perspective, we remain focused on improving operational efficiency, productivity, and resource utilization across our manufacturing and business operations. As the business scales, we expect better utilization of our existing infrastructure to support the operating leverage. Our approach towards the capital allocation also remains disciplined. We will continue to prioritize investment that support long-term growth, including R&D, product development, manufacturing capabilities, market expansion, and strengthening our distribution network. As we enter a new phase as a listed company, maintaining a financial discipline and creating sustainable value for our shareholders will remain key priorities for us. Looking ahead, our focus will be on sustaining the growth momentum, improving operational efficiencies, strengthening our product mix, and continuing to build a diversified and scalable nutrition platform. With the strong portfolio across macronutrient premix, clinical nutrition, therapeutic nutrition, and consumer nutrition, we believe we are well positioned to participate in the long-term growth opportunity in the nutrition sector. With that, I would like to hand the call back to the moderator for the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. I repeat, anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Sparsh Bedmutha from Perpetual Capital Advisors. Please proceed.
Hi, am I audible?
Yes.
Thank you for the opportunity and congratulations on good numbers.
Thank
So
you.
I wanted to know how concentrated is our export revenue among your top three markets, three, five markets? If two, three are like under-delivered, what's the earnings sensitivity we're looking at?
So overall export market, if we see the concentration for the top three countries you are saying, right?
Yeah, 3 to 5.
So it will be around 25 to 40% range of the initial top five countries we can mention.
Okay, thank you. My next question would be, our capacity utilization of 30% overall. Is that like across segments, or is clinical nutrition already running hotter than like premix and RUF? Where's the next bottleneck if that segment keeps on growing?
Sorry, you said that last time our capacity utilization was 30%. Is your question on that? There was a
Yeah.
bit of lag in your
Yeah.
question. And you want to understand the
Okay.
capacity utilization as of now. Am I correct?
Yeah. Yeah.
Okay.
And is
Your
it
voice
just
is
coming
cracking a
from,
bit. Huh.
am I
Yes,
audible
please.
now?
Yeah, you're audible, but your voice is cracking a bit. But please go on. Please go on. Yeah.
So I also wanted to ask, is it majorly like capacity utilization is coming from clinical nutrition, or are our other products also contributing to it?
Okay, Sparsh, I would like to answer this. So major of my capacity utilizations comes from the premix part, which contributes more than of my 50% revenue in the total segment. Okay, and then it comes from the branded segment.
Okay.
So overall,
Got it.
capacity-wise, we have seen a volume growth this quarter, which representing around 47% of total capacity utilization at this stage.
Okay. So now our current capacity utilization is 47%.
47, yes.
Okay. And my last question would be, what kind of revenue growth are you guiding for this year, FY27?
So this year we will be keeping a same growth trajectory what we have posted last year, around 20 to 25% growth range we will try to keep.
Okay, got it. Thank you.
Thank you.
Thank you. We take the next question from the line of Mayuresh Raut, an individual investor. Please proceed.
Yeah, thank you for the opportunity, sir. So I have a few questions. Sir, which business segment do you...
Sorry to interrupt, Mr. Mayuresh. I would request you to speak a bit louder as your voice is coming a bit low.
Okay. Now is it clear?
Better.
Yeah. So my first question is that which business segment offers the largest opportunity for you over the next 3 to 5 years?
So the branded segment is the one which we believe that is the fastest growing segment. So even in this quarter we have grown about 28% as compared to the last year same quarter. So and if you see the previous year's trajectory, overall our branded share has increased from in the total revenue from 18 to 20, 25, almost 30% now. So this is the one which I would like to focus on as far as your question is concerned. Thank
Okay.
you.
So another question. So how is the revenue mix between uh, B2C going to evolve? Like, and what does that imply for the margin profile? Like, how do you see the margins evolving as well then?
So, Mayuresh, to answer first your query, what is the revenue mix for the segment? So I can just mention that branded business contribute for this quarter, contributes around 28% of my total revenue. Then, premix business gives me around 62% of the revenue, and the remaining segment, therapeutic segment, that is ESG, contributes around 10%. So that is the revenue mix. And, next query, point was about the gross margin, right?
Yes. And I wanted to know actually how we are expecting the revenue mix to evolve as well in the segment, given segment.
Okay, given that, so all our three segments will continue to grow in the coming quarter. So there is a strong order book and the visibility is there for us. But from the management side, definitely we look across that the branded business will show definite growth of around last, as whatever the last year the growth turnover was there, it will show the segment by same growth there. Made better from that perspective.
Okay. And sir, how is the traction developing in newer therapy areas such as like fertility, healthy aging, and women's health categories? Like,
Yeah. So we have started focusing on those segments. Our fertility nutrition is from primarily we have developed for our export markets. So as we keep on entering the newer markets, we are introducing those products there. And as far as the focus on women's nutrition is concerned, last year we launched a product Neutron Women for that, which is available online primarily. So it's still in the infancy stage. So we will keep on nurturing that as we go along.
okay. Sir, also, so how quickly are we seeing that B2 scale business, C scale towards 35% of revenue? And uh, yeah, that is.
Sorry, we didn't understand the question.
So
Can
yeah,
you repeat?
do we see our B2C scale towards 35% plus growth of revenue? Like,
When will we get 35, the branded business of 35% of total revenue? Is that your question you are asking?
yeah, how quick?
How quickly?
Yeah.
That's a very good question. So in the next couple of years, we expect that to go to that 35% mark.
Okay, sir. Yeah, yeah. That's it from my end. Thank you so much.
Thank you.
Thank you. Before we proceed with the next question, participants who wish to ask a question may press star and one on their touchtone telephone. We take the next question from the line of Akhilesh from Ampersand Capital. Please proceed.
Hello. Hi, sir. Thanks for
Yeah.
the opportunity. So just wanted to understand your Q1 was 43% growth and you're guiding for like 20-25% growth. So do we expect there will be slowdown in the upcoming quarters?
You are asking that is there going to be a slowdown in the upcoming quarters?
Yeah. Yeah, because you're guiding for 20-25% growth, right? But your Q1 was substantially higher than that, 43%.
No, in fact, our Q2 is very strongly supported by a strong order book of around 100 crores. Okay. So
Okay.
there is definitely no sign of a slowdown in the quarter two. And as far as your question on the quarters is concerned, usually if you see our historic quarters also in the last 4 5 years, if you track the numbers, the first two quarters are always there to gather the momentum. But the main growth comes in the third and the fourth quarters. So you will see that across that seasonality you will see in this kind of in our this the seasonality aspect you will have to consider in our business, which is
So can
like
you explain your seasonality a bit more?
yeah. So that's what. So Q1 and Q2, as I said, you generally see that they are used to gather the momentum, and then when the momentum picks up, the Q3 Q4 you start getting that the higher rise in the revenues.
Got it.
And
So
that is
my yeah.
historically it is proven. I mean, if you see go back and see the previous years also.
Yeah. Yeah. So I don't have the previous year quarter numbers, but yeah, from what I understand, basically what you're guiding is that so your 20-25% growth might be a bit on the conservative side, if I'm not wrong.
Yeah. Basically, you can say the conservative side is 20-25% growth.
Okay. And sir, this quarter we saw some gross margin contraction. So what was the reason for that?
So, if you see the gross margin has contracted by more than 3% compared to last year quarter. The major reason is the West Asia crisis, where we have seen few of our critical raw materials in our segments in premix as well as branded has seen a rise in the cost. Okay, so that has really impacted us. But from the management side, we have definitely taken a call to pass on to the customers in an appropriate manner in the coming quarters. And it's a global impact, so we can expect that to remain, but all the necessary steps are being placed into system right now.
To protect the margins.
Yeah.
Got it. So from Q2 onwards, you will be back to normal track in terms of gross margin, if I'm not wrong.
Hopefully, yes.
Okay. And sir, can you also split your sales into price and volume in terms of what was the price growth this quarter and what was the volume growth?
Sure.
So overall, if you see the volume, the volume has grown roughly around 25 to 40% for this quarter. Okay. 25 to 40% this quarter, the volume has grown compared to last year's Q1. So we have seen the volume growth in both our premix as well as branded segments over the compared to last year.
Got it. Got it. And the rest would be price. So not a lot of price hikes in that case.
No. No. Price hike is not the main criteria with which we have risen it.
10 to 15.
So, but we have taken an eventual call in increasing our few of our branded products since the raw material price has risen. So the MRP of few of the products we have increased. So but the impact we will definitely see in the Q2 on our margin. Approx 10 to 15% we have increased our MRP. So that will see impact in the Q2 onwards.
Okay. Thank you, sir. That's all from my side.
Thank you.
Thank you. We take the next question from the line of Abhishek Maheshwari from Skyridge Fund Managers LLP. Please proceed.
Hi, thank you for taking my question. I wanted to know regarding other expenses.
I would request Mr. Abhishek to please speak a bit louder as your voice is coming a bit low.
All right. I wanted to understand about other expenses, the sharp increase there. Was it primarily due to the ocean freight and power and fuel, or there were other increases too?
You are absolutely right, Mr. Abhishek. The increase is on account of selling and distribution, predominantly on the freight part. Our freight cost has increased due to this geopolitical impact. And overall, if you see, we have also done a strategic investment in our selling and distribution in the sales promotion marketing. So there, my expenditures has little bit increased. We consider it as an investment at this moment. Just to add what our Vikram has mentioned, that we are increasing our footprint from tier 1 cities to tier 2 and tier 3 cities. So we have invested more than 50% in the field force capabilities on the ground, and that has bring impact in our employee expenditure also. But definitely this investment will give us a positive impact in the coming quarter as we increase our reach.
All right. Good to know, sir. Thank you.
Thank you.
Thank you.
Thank you. We take the next question from the line of Varun, an individual investor. Please proceed.
Hello.
Yes, hello. Good afternoon.
So my first question is on cash flow. Like, how did operating cash flow and free cash flow perform in first quarter?
So operating cash flow has performed better compared to last year.
Yes.
Hello?
Hello. Am I audible?
Yeah, audible. So by operating cash flow has improved compared to last year, Q1.
Yes. So has the cash conversion issue seen in FY26 has it been improved?
Yeah, it has improved. So there was a large scale of shipments in the ESG and the premix segment, which has improved this quarter. So major of our outstanding has been recovered.
Okay. And what happened to inventory days and receivable days? Like, when do you expect working capital to normalize?
So our inventory days has overall, you can say it remains more or less same because we have a good order book position for the remaining coming quarters. So inventory days still stands around 142 days as on the Q1. Okay.
Okay.
Compared to last year around 130 plus days. So because we have an order book position in our ESG segment and the premix segment for which we are required to stock critical inventories, and considering the rise in the product prices, with few of our strategic calls also we are taking to have some strategic inventory in our books.
Okay, perfect, sir. And were there any changes in customer credit terms, inventory stockings, or procurement strategy during the quarter?
No, there is no major change in our credit terms with the customers or the vendors.
Perfect, sir. Just last question from my end. Like, what is the expected FY27 capex? What returns and utilization threshold are being used to approve new investments?
So overall, so as you are aware that one strategic, there is a demolition happening at our Nashik factory for our premix facility, and it is redeveloping with the new infrastructure. For that, we will be incurring a capex roughly around 25 to 30 crores in the coming 1 year, or maybe 1.5 years. But we are taking a strategic call in terms of having a long-term borrowing from the bank to the tune of 70% of total capex, and so that will not impact much to our operating or our ongoing cash flow.
Okay. Thank you so much, sir. All the very best.
Thank you.
Thank you. We take the next question from the line of Urvija Shah from Isha Securities. Please proceed.
Hello.
Yes.
Hello.
Urvija.
Yeah.
Yes,
Yeah.
please.
Congratulations, sir, for a good quarterly result, being your first one. So you mentioned the order book a couple of times. So can you let me know the current order book?
Yeah. So like I said, the current order book stands at 100 crores.
And it is executable over how much period of time?
This is for that it will be executed in the second quarter and partly in the third quarter.
Okay. So this order book predominantly is, can you explain more? Because we have a couple of categories. So predominantly over which area?
So around you know,
and ESG.
yeah, 70 to 75% is amongst the premix and ESG, and the rest is with the branded segment.
Premix and okay. Okay. My second question is, what is our capacity utilization currently across our dry and powder and premixes categories?
Okay, Urvija, I can give you a blended one for your better understanding at this stage. Okay. So overall capacity utilization is runs around 40 to 47% at this moment. Whereas premix, we have three facilities in India, as you're aware. So every facility is showing a growth in the capacity utilization. So overall, if I can just mention, the branded business has also shown a growth in the volume and the capacity is also rising at this Q1 level. Same goes with the premix and the other ESG part.
And also it is important to note that this capacity utilization, when we talk about, it is across these segments where these the packaging differs from segment to segment. So for example, I'll give you, in the premix segment the packaging is done in 25 kg bags, while as in the branded segment it will go from anywhere 1 gram sachet to 20 gram sachets to 400 gram tins to 1 kg tins. So the premix kind of capacity utilization is slightly different in that, and in the branded segment it takes more time for the packaging. So these all factors we have to consider when we see this blended segment as well. So some of them, what I mean to say in that some of the segments might be more utilized than the actual blended capacity utilized. Some will be around, so right now Soman said that is 47% blended. So some might be operating at 65%, some might be operating at 35 to 40% also, some might be at 55% also. So this is the one which I want to all our investor and analyst friends to consider whenever they consider our company capacity utilization. Thank you.
Right, sure. Thank you. Okay, that's it from my side for now.
Thank you. Participants who wish to ask a question may press star and one on their touchtone telephone. We take the next question from the line of Meera Mittal, an individual investor. Please proceed. Hello.
Yes, please. Please go
Meera,
ahead.
we are not able to hear you. I would request you to unmute and then speak.
Hello. Good evening, sir.
Yeah,
Am I
good
audible?
evening. Yes, please. Yeah, yes, you are.
Yeah. So, sir, I just have two questions. So, what was the order inflow from UNICEF and other UN agencies, NGOs, and government nutrition programs during Q1?
Yeah, right. So we have got a good order book from the national governments of certain countries. So we are continuing the production for that now.
Okay, sir. And, sir, what is the current ESG order pipeline and how much revenue visibility does it provide for the balance of this financial year?
Right. So we will be looking at around 75 to 100 crores.
For the remaining year.
For the year.
Remaining financial.
Yeah.
Okay, sir. Thank you, sir. That would be from my side.
Thank you.
Thank you. We take the next question from the line of Kamal Jeswani from U First Capital. Please proceed.
Yeah, hi. Thank you for taking my question. Congratulations on a good set of numbers. I wanted to know what is, the raw material which we purchase are all domestically procured, or there are some imports also here?
So we have around 25 to 30% of the raw material which we are procuring internationally, and major of the raw materials we are procuring domestically.
Okay, and how has the pricing been in the last one quarter of the international procurement? And I think you had mentioned earlier that the freight also is impacted, so I guess the cost of raw materials imports would have gone up, I guess.
Yeah. So certain raw materials like whey proteins, they have seen an upsurge in terms of the cost, while as certain other vitamins, have remained stable.
Okay. Also, I was seeing that you all have plans to launch plant-based nutrition alternatives. So by when are you planning? And I guess the raw material for those also are one has to procure through imports, I guess. It's not available in India, I guess.
Right. Right. So as of now, we don't have any immediate plans of entering plant nutrition segment, but a few products we are trying to develop in the pipeline.
Among the ones which you mentioned, 5-6 categories.
Sorry?
Among the 5-6 categories you mentioned in the presentation, right?
Yes, but like I said, not in the immediate near future we have any plans for the plant nutrition segment. Okay?
Okay, got it.
Thank you.
Thank you. We take the next question from the line of Poshita Shetty, an individual investor. Please proceed.
Hello. My question is in context to exports. So, I wanted to ask, is your international growth primarily coming from the deeper penetration in the existing markets, or there are new entrants this time?
Yeah. So we are looking at good growth in areas like Central Asia and also Africa. And going forward, we are also looking for newer geographies which include Europe and North America.
Got it. Understood. Thank you. That answers my question.
Thank you.
Thank you. We take the next question from the line of Manaswini Mukherjee from Oracle Investments. Please proceed.
Hello, sir. I hope I'm audible.
Yes.
I wanted to know what was the capacity utilization across Nashik, Chennai, Uzbekistan facilities, especially in this quarter, and then how would you compare it to, say, FY26?
Okay, that's a good question, Manaswini. So Nashik, we can say the capacity will be ranged roughly around 55 to 60%. And Chennai will be ranging around 25 to 30%, and Tuticorin will be around 35 to 40.
And Uzbekistan would be?
Uzbekistan has just, we have few order book positions which are to be delivered in Q2 and Q3. So it is not that major to just mention.
Okay, that makes sense. So we can say that Nashik would be the highest available capacity then.
Absolutely right, ma'am.
Okay, perfect. Thank you so much.
Thank you.
Thank you. We take the next question from the line of Yash Parker from Patel Investments. Please proceed.
Hi, sir. Am I audible?
Yes, you are. Thank you.
Thank you so much for the opportunity, and congratulations on great set of numbers, sir.
Thank you.
So I have a question that our company is simultaneously investing behind B2C brands, expanding exports, scaling the underutilized manufacturing capacity as well, and creating new categories. According to you, sir, what are the biggest constraints of growth over the next 2 to 3 years? Would it be demand generation, manufacturing capacity, working capital, or something related to distribution?
So that's a good question. So as far as the manufacturing capacity is concerned, I think we have enough for the next 2 to 3 years to really scale up. So that's not a problem. Working capital is also very well managed with our debtors control and our inventory also. So that also I don't see a problem. Distribution, as you said, that we are planning to expand our distribution network, because as we said earlier that We are going into Tier 2, Tier 3 cities. We have appointed special field force to cover these particular territories. So along with that, the distribution network is also increasing, and that we have started that in the first quarter, maybe May or June, the people are on board. So we might see in the couple of quarters that they will start becoming productive, and the operating leverage will also kick in at that stage. Plus, as you said, you touched also upon on the capacity utilization, which has grown last year from 30% to now 47%. So that also operating leverage will start kicking in now in the next couple of quarters. More and more you will see of that. So we don't see any challenges from that point of view in our businesses.
Right, sir. Sir, and on B2C, you have already crossed 100 crores of revenue. Congratulations on that. And you're targeting more than 35% of the overall mix. What is the right way to think about the B2C growth trajectory from here? And how much of this growth will come from the existing brands like Pentasure versus newer brands such as Neutron and Opsango?
Obesigo.
Yeah.
So Pentasure still remains the biggest category of the brand. Okay, from where because we have 12 different brand extensions in that, and along with that, so that will still remain the biggest. While as the others we are focusing on that to grow. That is a Pedia Gold and Obesigo, what you mentioned. Neutron is a brand which is mainly we are focusing online. Okay. And as you talked about the revenue of this 35%, I think within the couple of years we will be able to achieve this revenue mix. We will be able to reach B2C or branded segment at 35%.
Right. And so the Uzbekistan facility, it appears to have significant headroom, particularly in the dry premix. So what is the strategy to ramp up this facility? Will it be catering to the local Central Asian demand, or will it be increasing to become like a export hub?
Right. So the strategy behind our Uzbekistan facility is to cater to the domestic requirement of the country as well as the export to all the neighboring countries, all the stans in Central Asia as well as Russia. I hope that answers the question.
Yes, sir. And sir, your D2C contribution is currently around 6.5%. So as you scale up the e-commerce and increase the HCP engagement, how do you see the channel mix evolving? Also, how should we expect any near-term pressure on the margins because of higher brand building and customer acquisition costs?
So we are strengthening our e-commerce business, our digital business with the social media initiatives. Okay, we have a social media handle, Pentasure Nutrition. You can follow that and you will get all the updates as well. What we do on the social media, we engage with a lot of different influencers, fitness influencers, mom influencers, so on and so forth, to really create more buzz for our digital channels. Also, if you go and see right now, the Freedom Sale is going on Amazon, so we do a lot of engagement on Amazon, Flipkart, even the e-pharmacies, Tata, NMG, NetMed, so on and so forth. So we advertise on these channels. We create the buzz during the festivals when we try to get this momentum of this, the festivals what they run now. The next festival which you should look forward to is the GIF, which is the Great Indian Festival of Amazon and Big Billion Days of Flipkart and so on and so forth. So this business is bound to grow by leaps and bounds. We keep on increasing our distribution centers there. So if you see that most of our orders are delivered, 85% of our orders are delivered within 24 hours. So we have a very strong fulfillment rate across all the portals.
Right, sir. So last question from my end. I just joined the call late, but still, like, if you could answer. the revenue growth was quite good in quarter one, but EBITDA margins declined meaningfully year-on-year. So could you help us understand the key drivers behind the margin compression? Was it largely product mix, raw material cost, or like higher investments in the B2C business? And how should we think about the margin trajectory from here?
Okay, yes, before I answer this, so I would like to just take you to one particular point. There is a growth in the overall segment. If you're seeing there's a 43% growth compared to the last quarter Q1. If I drill down to the segment wise, I can see that the branded business has grown 22%, premix has grown 55%, and ESG has also grown 42% year on year. So the growth and the volume in all my three segments is going up. Okay. So after this growth also the pressure is predominantly because of the gross margin issue that we have already discussed in one of the questions and briefed that critical raw material prices geopolitically has gone up, and that has created a pressure. But from the management side, we have taken action over that, how to mitigate those pressure on a gross margin, and we have increased our MRP from 10 to 15%. That will going to ease out the pressure in the gross margin in the next 2 quarters. Okay. And coming to the other part, why our expenses has gone up because of the freight cost to the West Asia crisis. This freight cost has risen up, which has added to the pressure in our impact. Whereas we have also done an investment on our field force. More than 50% of our field force have increased compared to last year Q1. And we see this as an investment which has impacted the bottom line at this moment, but definitely it will add value in the next coming quarters, and it will also result a positive growth in the revenue also.
So these new people which are on board, which they have just joined in May and June, so it will take at least a couple of quarters for them to show that productivity. So by end of quarter 3 or something, you can see that their operating leverage will also start kicking in. And as we are growing we are better utilizing our capacities, and we are growing our business. That operating leverage also you will see in the coming quarters. So we don't expect to see any problem with that one.
Right, sir. Thank you so much for patiently answering my questions, and all the best for future endeavors, sir.
Thank you.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, we take that as the last question for the day and would now like to hand the conference over to Dr. Nikhil Kirkar, Joint Managing Director, for their closing comments. Over to you, sir.
Thank you very much. Thank you everyone for your valuable questions, for taking the time to join our Q1 FY27 earnings call. We hope we have been able to provide you with a clear understanding of our quarterly performance, our business priorities, and the opportunities we see ahead. We remain focused on executing our strategy with discipline, strengthening our businesses, and delivering sustainable growth and long-term value for our shareholders. Should you have any further questions or require any additional information following today's call, please feel free to reach out to Saloni Nagvekar, our investor relations contact at Adfactors PR. Once again, thank you for joining us this evening. We look forward to continuing our engagement with you throughout this year. Have a good evening and a happy Independence Day. Thank you.
Thank you. On behalf of Hexagon Nutrition Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.